Thank you for the introduction, and I'm very pleased to moderate this panel session. And I believe that the role of this panel is to kind of showcase that what the financial institutions are thinking and doing and planning to do in respect of supporting transition to net zero. And in that perspective, we have a set of distinguished panelists on board from the banks and asset manager and asset owners. So that is a very important part of this panel discussion. Well, as we have been all discussing so far, the transition to net zero is a kind of system change. And so it requires certain transformation of the economic and social system. And finance is a kind of enabler for such systemic change. And that is why we are discussing how to construct an ecosystem for transition finance, which is comprised of, certain disclosure of emission and also setting credible pathways and also how to develop credible transition plans by companies. And right now, those efforts are made through many initiatives, but as mentioned in the keynote dialogue earlier, the G funds and the other net zero alliances play a very significant role. Our net zero planning for financial institutions is one of the core areas of G funds and other net zero financial initiatives are actively working on. And the focus of the work spans from a transition plan framework for financial institutions and the guidance for real economy company transition plans, and also guidance on decarbonization pathways across sectors. So from that perspective, I would like to first ask Simon, because in making a transition finance, that financial institution needs to make a certain forward-looking judgment. So in your view, what would be the best way to set sectoral net zero pathways for such assessment and evaluate plans by real economy companies, particularly for hard to abate sector companies, and how likely would your views on that aspect feed into the G funds and other net zero finance initiative framework and guidance? Simon, could you kick off?
Thank you, Satoshi-san, and a pleasure to be with you virtually this afternoon. So I think we should be incredibly grateful to the International Energy Agency for their Net Zero 2050 scenario. When the Net Zero Banking Alliance was being formed, when some first movers in the financial services sector were creating their own net zero commitments, the scenario didn't exist, which made it much harder to conceptualize what we meant by net zero. And as we think about that net zero scenario, we shouldn't underestimate how important it is for two reasons. The first is the insight it offers into changes needed in the global economy to reach net zero. And the second is the debate it provokes, given the urgency and the severity of some of those changes proposed by the IEA. That debate is needed because this is only a scenario. It's an economically optimized set of outcomes that gives us 50% chance of achieving 1.5 degrees in the global economy. And because of that, it requires further work in at least two ways. The first is to add additional detail. The IEA's NZE 2050 is really only looking at the energy sector and doesn't get more granular than OECD versus non-OECD. So thinking about the different business models of financial institutions, the geographies and the clients they serve, there is a need to augment that scenario, to understand its impacts and how you work with it as a planning tool. And the second is then that we are in a dynamic situation. If globally, regionally, in individual markets, there is a choice not to embrace the IEA's policy recommendations, then there will be trade-offs needed elsewhere to help ensure that global emissions reduce at the levels needed to achieve net zero. And in that context, I think we can start to unpack some of what it means to use the IEA scenario when we consider sectoral pathways and when we consider companies' transitions. And my main request to the audience today is not to expect perfection there, both because of those factors I've just laid out and because, as you said, this is a very new area of work. But we can start to see, if we look at that IEA scenario, some of the enabling transition technologies, and those are critical in guiding client conversations. So at Standard Chartered, we've taken the IEA scenario and we've used it to develop a transition finance framework, one that takes those technologies included in the IEA scenario, which may not be there in the economy at scale at the moment, which we may not be providing financing for, and tries to assist that financing. And that's supported by a commitment to mobilize 300 billion in green and transition finance by 2030, $300 billion. Sorry, I should have said. But if that's about what we're doing as one individual financial institution, to me, this all sits at the heart of the GFAN's program of work. So I'm lucky enough to chair the Net Zero Banking Alliance and to sit on the steering committee of the Glasgow Financial Alliance for Net Zero. And as you've said, that includes a focus on sectoral pathways and a focus on both financial and real economy transition plans. And that's needed because that's collective, collaborative work. The very reason GFANS exists is this work shouldn't need to be done by every individual financial institution. It should be there as a resource for everyone to draw on. But there is also a need to take it to the next level of detail, to make it applicable to specific parts of the financial system. And I think that's where the Net Zero Banking Alliance comes in, through the sectoral work tracks, including those that Tomo-san is helping to run, and the implementation work tracks and the efforts of individual banks to make sure that we can then take that work. The IEA has given us the direction. It's helped given us where we think we should be going. There's then a need to translate that, as you say, into sectoral pathways, but recognizing that there will be flexibility here and that we understand and we're able to manage that dynamic environment. And then financial institutions have the tools to be able to use that, to engage with their clients, to manage their portfolios, and thus themselves to set their own transition plans.
Thank you, Simon, for sharing your perspective. And the work at the Net Zero Banking Alliance, I think, is moving forward. So, as Simon-san mentioned, that the Tomo from MUFG Bank is also working on that issue at the Net Zero Banking Alliance. So, I would like to ask the same question, Tomo. Please go ahead.
Sure. First of all, thank you very much for the invitation, and very glad to be here. And Simon, good to see you, although virtually. I think this journey or the project that we're doing, I think it's great that we're not just working individually as each institution, but rather as an alliance. I think this is very important to send a kind of collective signal to the real economy, but also to public sector officials, so that we're talking in one voice. I'm happy to come back to that. But before responding to your question, if I may step back a little bit and offer two observations. First of all, as you mentioned, Ikeda-san, I'm convinced that transition finance is the key enabler to achieve a sustainable future. But by virtue of transitional nature, however, the subject of transition finance is non-green, but greening. And expectation is that it will contribute to achieving Paris-aligned goals. I strongly believe transition finance in general is a good thing, as long as it facilitates credible transition plan. However, one could criticize transition finance as one form of greenwash. But perhaps it's worth asking why greenwash is bad. If a financial institution like ours offer an investment product as green when it is not green, then that is a misrepresentation, therefore against the notion of investor protection. I get that, and I'm sure you all agree. However, labeling financial institution to support transition of the real economy as greenwash is, to me, counterproductive. If I may be blunt with all of you, but because it may stifle the provision of transition finance. So the question is, where do you draw the line between good transition and not so good transition? Where's the line? Is it here or is it there? That's the first comment I wanted to make. Second, under the leadership of Simon Connell, as the chair of Net Zero Banking Alliance Steering Group, we actually established a working group with the mandate to draft the Transition Finance Guide. And I'm privileged to chair this group. We're drafting the guide as we speak, but as the chair of this group, I define the success of this guide as mainstreaming transition finance at each Net Zero Banking Alliance member bank, but hopefully other banks will follow too. Given Net Zero Banking Alliance is a global alliance with more than 100 members, different banks will draw lines at different places. Yes, it isn't perfect, but I would argue, don't let perfect be the enemy of good. We have to start somewhere, and the world isn't homogeneous. So I do think that one size fits all isn't appropriate. Further, I think being too ambitious from the get-go may stifle some banks, especially in emerging economies, as evidenced by only a handful of banks committed to net zero from Asian countries, for example, or Middle East. In this sense, the idea I'm putting forward is inclusive yet ambitious, and encouraging all banks to be part of this project, even if some banks may be less ambitious in the beginning. You may argue that we don't have much time left. True, but decarbonizing regions and firms with sufficient capabilities only and leaving others behind isn't the right path to net zero. So what does all this mean? I would like to come back to your question, Kida-san. Banks have an important role to play, encouraging firms, including those in the hard-to-abate sectors, to come up with net zero roadmap, respectfully challenging the plan, and if convinced, support the transition with financial support or financial solutions. In this sense, banks have a unique role within the financial sector because we not only engage, but support every step of the way of transition journey. As I said, banks have the responsibility to challenge the plan in a constructive manner as part of the due diligence process, and key area to focus would be intent and ability. If a firm is committed to achieve net zero by 2050 and has a convincing plan, I think banks are encouraged to support the plan. It's better to put net zero plan into action, even if the plan aren't perfect, rather than wait for the perfect plan to emerge. So some may argue the net zero plan has to be science-based. I get that. And I'm not opposing to the idea of science-based, but we have to remember it's human being that's running companies, right? It's not science, it's not AI, it's human being who's running the company. So on top of technologies and innovation and science, there has to be strong commitment by the top management. And this is why intent and ability are both critically important in the context of transition plan. So we're including these components in the Net Zero Transition Finance Guide that we're preparing, and hopefully this guide will allow us to mainstream the transition finance, which I think, going back to your original question, hopefully I answered your question. Thank you.
Well, thank you. Thank you for your very elaborated answers. And well, I would like to say that it's very important to make a certain distinction between the green transition or net zero transition and intermediate transition. So what goal that the transition activity would like to achieve is a very important aspect when we suddenly assess that the credibility of transition finance itself. So, with that comment, I would like to ask the next question to Keith. Well, when our prep call is held, you made a certain comparison between Climate Action 100 Plus and the G funds. And I would dare to say that the maybe G funds and the Net Zero Banking Alliance is a kind of the that banking sector is kind of joining the bandwagon of the ESG movement very lately. So, well, what is your assessment of such comparison, and what would be the, I would say, implication for the bankers from the kind of engagement versus divestment discussion among the Climate 100 Plus Climate Action 100 Plus initiative, and what is your view on managed phase out of the stranded asset? Keith was used.
Right. Well, thank you, and I hope you hear me well. And thank you for inviting me onto the panel. and sorry I can't be there in person. Firstly, just to say I endorse the comments made by the previous speakers, and I think you're absolutely right about we're not dealing in a perfect world. We have to deal with imperfections every single day in our decision making. A lot of judgment has to go into these issues, right? This is all about getting the right data. It's all about understanding our true impacts that we as banks and as investors are having. Where is our finance going to? But then there's a lot of judgment that goes into it. To what extent is a company really credible in their transition pathway? And to what extent do they need to get more capital into that business to accelerate and support them on that transition, even when today, or even historically, they've been a very high emitter? And that's a judgment call that everyone around this table today, and presumably in the room today, has to make. But we need the data, but then there comes the judgment. And that is a key element, and that's one of the reasons why we at Citi have developed what we call our transition principles to help guide us. We have a lot of debate internally to ensure that we understand as a team, once we have the data, how do we make really important decisions in terms of allocating capital. So I think on your question about Climate Action 100 Plus and GFANZ, I think we owe a lot to Climate Action 100 Plus as well. This has been a group that has started a number of years ago to really engage with companies on their transition pathways. It now has in the order of 17 trillion of assets under management amongst 700 investors. And what they do is they target a group of 166 companies. These are the companies that are hardest to abate in the world, representing about 80% of corporate emissions. It's currently mostly, energy, power, transportation, cement, steel-making companies, etc. But the way in which they've developed a framework, or what they call the benchmark, on transition is important, because it's, to my point, about us as a community using a framework to assess corporate credibility or the credibility in their transition plans. And that framework has become very influential, very important, and I would recommend it to not just to investors but also to the broader community. It's also a group that obviously is engaging with companies. Now, again, we also owe a lot of credit to the divestment movement, but in the end, Climate Action 100 Plus is very much about engaging with companies and to support them and accelerate them on their transition journeys. However, on the most recent report they issued, what they found is that whilst in the order of 42% of their target companies, the 166 companies, have set themselves Scope 1, 2 and 3 targets, only 5% have actually got their capital expenditures aligned with those targets. So at the moment, there's a big gap between target setting and promising versus doing. Now, that's understandable because you've got to start with the target. You've got to start with the awareness, and then you've got to set the targets. And then it takes a while for it to filter down into actual corporate action, and particularly when it comes to allocating capital. But at the moment, there is a big gap between those promises and targets versus actual capital expenditure alignment. And then on GFANZ, no need for me to summarise anything there because previous speakers made it very clear. It is a fantastic collaboration. Let's face it, we should have set it up the day after the Paris Agreement was signed, but it takes time for these things to get together. But it is a very, very powerful collaboration because it is a mutual commitment for each and every one of us to set ourselves to establish the methodology to measure and understand the financed emissions, so where our capital goes. So we, for example, and I know everyone else on this panel has as well, it forces us, obligation is to assess and to measure the embedded emissions in our financing activities, and then to set the appropriate targets to 2030, not just 2050 net zero, but 2030 aligned with the 1.5 degree world. And it gives us that granular data to then make much more informed decisions. It only works if we're all doing it, by the way, because what we'll find is that if everyone here is doing it, but there's a whole bunch of capital that is not, assets will flow to that capital. Assets will flow away where it's not then decarbonising. So it's very important that all of us continue to get more members into the group, and that we also ensure that it goes not from just the top of the house, but down into the weeds, down into everyone who's making these decisions day to day. That is a critical element of success for this theory of change to work. That then flows into the questions you ask about engage versus divest and manage phase out, because this helps us then frame the decisions. Both are important, engaging, in certain circumstances, divesting, but certainly the managed phase out of assets is critical. But once we've got the data, that provides better decision-making tools, and then the ability to shift the capital towards those solutions, including managed phase outs of assets, will be critical. Thank you.
Thank you. Thank you for your comment on the importance of data for making very critical decisions. And well, let's turn to Emily and Miyuki. Well, because the BlackRock and the Daiichi Life both are G Fund's principal group member company and also a Climate Action 100 plus member company. So with that status in place, so what is your game plan for driving transition to net zero by real economy companies through finance, and both in terms of kind of proliferating the mature and early adoption decarbonization technology, and also in terms of, as we discussed already in the previous panels, accelerating the development of the decarbonization technology that are still in the pilot stage or in the R&D stage. First, Emily, could you come forward?
Thank you, Ikeda-san, and thank you for the invitation to speak today. It's a real privilege to be able to participate. So look, as an asset manager, BlackRock's role in the transition is as a fiduciary to our clients. The money that we manage is not our own, it belongs to them. So, our game plan for influencing the transition will necessarily be different from that of my fellow panelists speaking today. So our role is really to help our clients navigate the investment risks and opportunities that are associated with the transition by providing them with the tools that they need to make informed investment decisions. There's three main ways by which we're committed to doing that. Firstly is around measurement and transparency, both in our fund disclosures, but also the ongoing development of data and analytical capabilities that really help them understand the impact of the transition on their portfolios. Secondly, what we're doing around stewardship, so what we're asking of our investee companies and how we use our votes to promote more sustainable long-term investment outcomes. And then thirdly, which goes to the crux of your question, is really around investment management and how we're incorporating climate into our top-down asset allocation, as well as the depth of our active ESG integration, and of course, the breadth of our product offerings as well. So on that last point then, we see three main levels through which investors can choose to participate in the transition across their asset allocation decisions. And we frame these as what we call navigate, drive, or invent. And so the starting point is what we call navigate. And this is really thinking about how the multiple forces of decarbonization might impact entire portfolios, and really has implications for how we think about managing risk at the security and the sector and portfolio level. And it's our belief that this really needs to be the default position of all investors now. So we're really aiming to offer solutions across asset classes that help clients to green the whole core of their portfolios. But secondly, we're hearing a lot more from clients who really want to do more than just understand how the transition may unfold. They really want to help proactively drive it forward so that they can help to capture value, but also contribute to progress. And this might take two forms. First of all, investing in companies that have green business models already in more mature areas. And so that might be classic things like renewable energy or EV technology. But secondly, and this has come up a couple of times on the panel already, is how we're thinking about investing in carbon intensive companies that are positioned to lead decarbonization within their industries. So as one of my colleagues on the call said, that this question of greening from brown to green rather than companies that are already green. So our aim in this drive bucket is really to offer clients investment options that hone in on those two dynamics. And so we have thematic strategies like our climate finance partnership or our global renewable power franchise or green bonds or active public and private markets funds. And then kind of the next step along from that is lastly how we see huge opportunities to invest in the technologies and the businesses that are needed to really invent the net zero economy. And this is about accelerating the development of many of the technologies that we need, the climate tech of the future, if you will, like green hydrogen or carbon capture or green cement or sustainable aviation fuel. And a lot of those technologies exist today, but they're not yet economically viable. So we need capital earlier in the tech adoption cycle to really commercialize those nascent technologies and to invest in others that might not even exist yet. So we're looking to provide flexible venture and growth capital to really spur innovation across a range of use cases, including both disruptive startups as well as project finance. And so a good example of that would be an effort such as our Decarbonization Partners venture with Temasek, which will be looking to provide the opportunity for clients that want to invest in that climate tech of the future. And it's a key objective here at BlackRock to look to expand those types of strategies and opportunities at the firm in due course.
Good. Thank you. Well, I hope that the BlackRock will set up a fund for Japan in the future. Next, I would like to ask Miyuki-san for the same question, please.
Thank you very much for inviting me today, and my pleasure to join this panel. Dutch Life Insurance is a long-term investor and an asset owner. And as an asset owner, we joined Climate Action 100 Plus in 2019 because we believe that becoming the member of the Climate Action 100 Plus will demonstrate our commitment to carbon neutral in Japan and encourage companies in which we are shareholders to accelerate their climate action initiatives, which will ultimately lead to the early achievement of carbon neutrality for the assets we own. The same can be said for our becoming the first Japanese companies to join the Net Zero Asset Owner Alliance. The Net Zero Asset Owner Alliance was launched, as you know, at the United Nations Climate Week in 2019. I was there in New York myself at the time to experience the great swell of global coalition in response for climate change. In 2020, Japan began to speak out about a shift in energy plan. And our company quickly moved to sign the Net Zero Asset Owner Alliance. We recognize signing of the Net Zero Asset Owner Alliance have much greater impact, not only on our invested companies, but also on the people in Japan than signing the Climate Action 100 Plus. Last year, before COP26 was held, we reached out to major Japanese insurance companies, leading to their participation in the Net Zero Asset Owner Alliance. We believe that this was demonstrate of Japanese asset owners' commitment to carbon neutrality as G-funds at COP26. In addition, a recent appointment as a member of the principal group of G-funds is a great opportunity for us to promote dialogue with Japanese companies. In addition to the dialogues with the portfolio companies mentioned above, as we identified issues in each our asset classes and prioritizing measures to achieve carbon neutrality for our own portfolio as a whole. And we have reached our latest commitment, including roadmap and targets this spring. Our company is working as one to raise awareness of carbon neutrality, not only within the investment division, but also across the company, including the risk management division and other related divisions. In the investment department, we are actively working on investment opportunities for new financing vessels that contribute to net zero emissions, investing such as transition bond, green bond, and linked loans. We also made impact investment to accelerate innovation to support the transition. In addition, we are constantly striving to enhance our knowledge and also the sharing our knowledge through the G-funds participation, and also to find out new technologies and R&D by utilizing external evaluation initiatives and also the institutions and collaborating with others, including university in Japan. Thank you.
Thank you, Miyuki-san, for claiming that the net zero transition is now the whole of the company project. Well, I have to warn that the audience that I haven't received any questions and comments yet, so please send them along. I'm planning to have a certain Q&A session later, so please do that. And well, okay, thank you for those perspectives already shared. Well, and I would like to go for the Emily-san again for the next question. Because many Japanese companies are very much interested in knowing that how they are perceived by institutional investors. So I would like to ask, what is the BlackRock's macro assessment of Japanese companies' transition to net zero prospects? And that assessment influence the investment stance towards the Japanese equities and debts? Emily-san, please.
Absolutely. Look, we've actually been really encouraged to see Japanese companies taking a leadership position, particularly in climate disclosure. And that's been represented by the largest number of TTFD supporters in the world. So actually, Japan has 20% of the total global number. And in particular, our investors are actually starting to see a greater depth in climate disclosure from Japanese companies, particularly in their scenario analysis, and actually how that is starting to be reflected into corporate strategy. And then if we turn from disclosure to actual commitments, if we look at something like the Science-Based Targets Initiative as an example, Japan's actually been a major contributor to its global growth as well. So Japan has the third highest number of companies with an approved target or commitment among the G7 nations. And that includes 31% of Japan's high impact companies. So that's its largest, heaviest emitting companies. So we now see around 30% of companies in the MSCI Japan as having approved science-based targets, and another 6% have commitments to do so. So it's really tracking along well there. And another interesting way that you might think about this from a macro perspective, and I just kind of ran this analysis yesterday, might be thinking about implied temperature rise, or ITR metrics. Which is basically an indicator of the temperature rise that the world would see by 2050 if your portfolio represented the global economy. And when we ran these numbers for MSCI Japan, we looked at two different data providers that had slightly different methodologies. The model that only covered scope 1 and 2 emissions placed MSCI Japan significantly better than MSCI World in terms of its net zero alignment progress, whereas the second model that actually included scope 3 emissions found MSCI Japan to be behind MSCI World. And what that tells us is, while Japan is performing really well operationally on a relative basis from a transition perspective, the main challenge is going to lie in its scope 3 emissions. And that's mostly driven by the manufacturing and materials and retail value chains. So bringing these observations then to the company level investment outlook, if we think about sort of historically the lack of fossil fuels in Japan, companies have really for a long time already been focused on energy efficiency and eco-friendly products. So Japan's got really strong experience in energy saving technologies, all the way from lightweight materials for aircrafts through to heat pumps for air conditioners. And with a high market share in Japan, those companies have already had the edge in expanding abroad and taking market share from foreign competitors. And the move to net zero is really helping to accelerate that. And so Japanese manufacturers of technology, for example, things like inverter controlled air conditioners or lithium battery machine tools, they're really well positioned globally. And we're really expecting to see greater global leadership by Japanese companies to navigate the transition from a technology perspective, particularly in areas such as mobility and hydrogen and CCS and steel. And so that leads us to remain bullish on investing in the equity of Japanese companies that have competitive advantages on key decarbonization technologies. And then if we think about the fixed income side, we're also expecting to see transition finance grow under strong government initiatives in Japan. So, for example, we saw the FSA, MOE, and METI jointly formulate the basic guidelines on climate transition finance, really urging investors to allocate capital for the transition to net zero with a focus on particularly the high emitting sectors and providing the sector-specific roadmaps to that. And we're going to keep monitoring those developments because, as I mentioned earlier, we really believe that an underappreciated investment opportunity actually actually lies in identifying carbon-intensive companies that are really positioned to be at the forefront of decarbonisation within their specific industries.
Thank you, Emily, for sharing the very encouraging message, but also the certain challenge we have to solve. And well, we've been discussing how to set credible pathway, and certainly that is a very important element for financial institution to evaluate the transition plans by companies. And well, this theme is recurring throughout this symposium, but I have to also touch upon that. That is the energy transition and the effect of the war in Ukraine on that. Well, energy transition is an integral part of the transition net zero, and the energy transition is a particularly, I would say, difficult challenge in Japan. And so how the financial institution will assess the such transition after the war in Ukraine is, I think, of particular interest to many Japanese audience. So I would like to ask this question to Simon and Keith. Well, is it right to claim that the decreasing energy dependence on Russia will lead to a certain detour in the energy transition journey, with more certain investments in non-Russian fossil fuels expected in the coming years? And well, how do you factor a certain ramification of the war in Ukraine into your assessment of companies' pathways to net zero? First, Simon, please.
Thank you, Satoshi-san. The short answer is, I hope not, but let me give a little bit more detail. Building on my earlier comments, scenarios only offer an optimized path towards an outcome, in this case, toward net zero, or to borrow the old phrase, all models are wrong, but some are useful. And we can't expect the transition to progress exactly as a scenario says it might do so. And so with the conflict in Ukraine, here comes the noise in the model. And understandably, what we're seeing as a first order response is to start to unpick the concept of just transition. As we're seeing the cost of energy increase, governments are coming under pressure to protect the most vulnerable, individuals and maybe small businesses, from those costs. From my personal perspective, what I think would be very regrettable is if that led to directing too much resource towards managing the operating expenditure, if we call it that, arising from those increasing costs, if it was just a continued subsidy, because that's not going to drive the transition and the change we need. The scenarios and the reality tell us that we need to transform our energy systems, and with an initial focus on generation. So my hope is that in responding, policymakers' reaction to the Ukraine conflict is to help citizens and businesses manage through the capital expenditure of the transition, to use this to spur the transition, to spur revolution in generation technologies. Because if we're going to have a cost, we should have that cost support the transition rather than just continue to perpetuate the existing system. But I think we should also reflect as we do that on the significant impact of demand side action. Under the IEA 2050 scenario, energy demand doesn't look like it changes that much because it's 8% lower in absolute terms. But if we look at some of the other assumptions in the scenario, with changing population, changing GDP, energy demand is roughly half the current levels as a factor of GDP, or less than also lower by a quarter as a factor by head of population. And so again, and acknowledging here that some of this is not quite the way people would want it to play out, we need to take action on supply and demand. And as we've seen with previous oil price shocks, as the cost of energy increases, it accelerates that demand side as much as governmental action is needed to tackle the supply side. So the conflict is a tragedy, but what would be a double tragedy is if that were to hamper rather than spur that transition to net zero, and if it were to harm both supply and demand side measures.
Thank you, Simon. Your message is very clear. So, Keith, could you come forward?
Sure. Thank you. Look, I again endorse what Simon was saying. I think, in fact, this is a long-term journey to net zero. We all know it's not going to be achieved quickly, but we have to act quickly, and we have to act consistently. Unfortunately, in the world, there will be more crises. If we're talking about a 20, 30-year pathway to net zero, excuse me, we're going to have, unfortunately, more instances, whether that's crises like wars, pandemics. The reality is that the planet will, on average, continue to warm for as long as we are not achieving net zero. And the earliest I think the world is looking to achieve net zero is 2050. So in effect, the world, on average, will continue to warm, and we will continue to have increases in extreme weather events as a result for many, many years to come. So what we have to do is build resilience into our pathway to net zero, because we're going to have more instances like this. And as Simon was saying, we cannot let a crisis like this go to waste. We have to learn how to leverage situations like this to continue to accelerate the transition. We know there's going to be bumps in the road. It's definitely not going to be a smooth and consistent and entirely predictable transition. It's going to be tough, but we have to build in that resilience and that determination at the political level, at the business level, throughout finance, and also with our communities. We have to ensure that people on the ground are well led, but are well educated, and educated in terms of climate. And Simon also touched on the just transition aspects. We have to make sure that, for example, energy prices can continue to be managed in a way that people in the community can afford to pay. So, building this resilience is going to be important. Fortunately, the response from the EU to the crisis in Ukraine has, in my view, been very positive. To come out with a $300 billion Repower EU plan that builds both security, energy security, as well as accelerating the transition to net zero is the right answer. And in fact, renewables and other forms of clean energy are consistent with energy security and energy independence, although clearly there'll be some countries in the world that won't become energy independent. It'll just be a rerouting of trade routes. For example, green hydrogen is going to be a very important facilitator to the energy transition, and that will require new trade routes, exporting from, for example, renewable energy-rich regions of the world, converting that to green hydrogen, and then transporting it to regions that need it. So there will be a realignment of these trade routes, these energy trade routes. That's going to be an important part of the infrastructure that we build. So in summary, my view is that the crisis in Russia and Ukraine is one that should and probably will accelerate the transition. There'll be a short-term bump in terms of increase, for example, in coal production in certain regions. But overall, we've seen the EU respond in a very positive way. For example, the 2/3 of the transition this year to get off the addiction to Russian gas, 2/3 is coming from renewable sources such as green hydrogen, such as biomethane. So there's a very positive initial response, but we definitely need to continue to accelerate that. Simon also touched on, just transition. I would emphasise this is not just an energy crisis; it clearly is a food crisis as well, and that is food systems playing a very important role in the transition to net zero, given that the food systems contribute in the order of 30% of global emissions. So us focusing on reinventing the global food system is also going to be arising out of the Russia-Ukraine crisis. Thank you.
Thank you. Well, you mentioned about a certain food issue related with the war in Ukraine is a very important point in the short term. We already heard from the Simon Keys that how financial institution would evaluate energy transition in the aftermath of the war in Ukraine. I believe that the many Japanese audience also interested in knowing more about how that the sectoral differences and geographical differences will be considered in setting transition pathway benchmark for assessment and actually assessing the transition plans by companies. So I would like to ask this question to Miyuki, Tomo, and Emily. Do you see any challenges or opportunities specific to Japan or APAC countries? And also in this respect, do you see any gaps between views on orderly transition among financial institutions and those among real economy companies? And if this is the case, how can we reconcile such gaps in view between the financial sector and the real economy company sector? First, Miyuki-san.
Okay, thank you very much. Yes, we actually see the gap between the financial institutions and the companies. But before thinking about these themes, I think like this. Global warming is a challenge for the Earth. So we have to consider as a global issue, of course, as you already know. First, we have to consider GDP portfolio will be different in the future. As you have watched the conversation between the Mark and Hiro in the video, we always have to think about emerging countries. Second, the IPCC report also proved that global warming caused by carbon emission has been the result of the accumulated emission by the developed countries since the industrial revolution of 100 years. In order to halt global warming while accepting the growth of emerging economies in Asia and Africa, we believe that the developed countries should be future-oriented, incorporating the opinion of each region, especially those of fast-growing Asia, and discussing issues in a fair manner, taking human rights and economic disparities into consideration, and incorporating diverse opinions into rulemaking. And there is a strong movement to apply the EU-centric rule to other regions, but this may make some items difficult for emerging countries as well as Japan to accept. And we believe that Asian opinion should be incorporated in discussion on these issues. Third, in particular, for companies in the industries where company size is large and transition take time, it is necessary to have them consider countermeasures as soon as possible. We also believe that dialogues with companies will help them recognize the needs for unique Japanese innovations to enable them to execute just transition based on Japanese industrial structure, and help the world understand the regional characteristics including Japan. We believe that some companies in certain industries, like steel or cement, may need to make drastic changes in their business models. But we like to consider these challenges as business opportunities rather than a backward-looking stance. And at the same time, we like to consider providing financial support, including transition finance, to enable transition. So we like to watch the First Movers Coalition. In this means, I'm very pleased to hear that Mr. Kajikawa mentioned about Japan's green transformation strategy with an alliance with the First Movers Coalition today. Thank you.
Thank you, Miyuki-san. So, Tomo-san, please.
Sure. First of all, today's panel discussion I thought was very interesting, and I was listening to the previous panel on the energy transition discussion, and given Japan is where it's located versus other regions, I don't think we can come up with one-size-fits-all solution, nor that I can offer any additional, how should I say, observation for the sectoral or geographical discussion. So I'd rather perhaps offer to all of you some of, how should I say, observation from a practitioner's perspective. Two things I wanted to, first of all, cover. One is that when we look at transition plan, I think we need to look at it from two angles, one being macro and also the other being micro. When I say macro, I think when we talk about credible plans, that's when we talk about macro. Basically looking at the group firm-wide transition plan, is it credible, is it not credible? I would call that as a macro level assessment. But it's also important, or we should not forget that micro assessment is also important, because we're a bank. I'm sure it's the same for BlackRock or Dai-ichi Life. We just cannot say, because this company has a credible plan, we'll just write a blank check to anything going forward for the next 30 years, 40 years. Doesn't happen, right? You need to be convinced that the firm has a credible plan, but also case by case, you need to do micro assessment or due diligence, just like any lending practice that we've been running for decades. So what I'm trying to say is, I guess under this zeronomics era, we need to look at it from both perspectives. Used to be, if you're lending to a cash flow rich project, your credit guy may say, done, it's good, there's collateral, you can lend it. But nowadays, you need to look at it micro, that you have the collateral or the sufficient cash flow interest coverage is there. But at the same time, you need to look at the firm level macro transition plan, and that you're convinced that this lending you will give will eventually allow transition of, in the next 30, 40 years. So I will call this both thumbs up. So basically not just one thumbs, but you need to basically say micro, macro, both good, so that you can lend. And that's how we should transform our business plan. So that's one thing I wanted to mention. But also in terms of gap, your question, I guess, Simon, you mentioned about just transition aspect. I also want to come back to this orderly transition discussion, which is, I'm sure we all agree with just transition or orderly transition concept. But again, they will live in the details. We don't want to see inflation, at this level going forward. But at the same time, unless we do orderly transition, we may see more, higher inflation going forward. So I think what we need is gradual transition of energy supply. And as we heard in the previous discussion, you can't just simply generate energy somewhere and bring that to Japan or vice versa. It doesn't happen that way. You need to generate and you need to consume in where you basically generate your power. So you need to look at kind of a micro level and supply and demand. You can't just look at the macro level and say, because there's a renewable somewhere, that should be, sufficient for the purpose of energy here in Japan. So I think there's that kind of a micro level discussion we also need to look at. Lastly, in the context of emerging economies, where many of our institutions, including ourselves, operate, I think there's a gap that we need to look at. It's important to remember that financial sector cannot run ahead of real economy, and we need real economy to change to make the economy more energy efficient. So we committed to 2050 net zero or 2030 interim target. That's there, but we need the real economy to also transform. We just cannot go ahead and say our balance sheet is green, but the rest of the real economy is very brown. And all of a sudden that will basically divide financial sector and the real economy. There's no connection, which is not the outcome we want to see. So we can catalyze change, but we cannot drive change. So at the end of the day, that's where I think the engagement comes in, or that's where we need to have dialogue so that our clients understand where we are heading, but we also understand why our clients are moving at whatever the pace. So there's got to be that mutual understanding, not just one-way communication, one way saying you need to hit this by 2030, 2050, or we will not just lend, because that will just leave those sectors or those regions behind, which is not what I would call orderly transition. Thank you.
Thank you for your very passionate speech, I would say. I would like to ask the same question to Emily-san, but at the same time, because I received a certain question why certain flexibility important, but how to avoid greenwashing or transition washing is also important. So how we should do about it. So if you answer that question too, that would be very welcome. Emily-san, please.
Sure, I'm happy just to jump straight to that question in the interest of time, if you like. Look, I think it's really important, and this was raised at the beginning of this session, to understand that when you talk about sustainability and sustainable investing, it really is not a one-size-fits-all approach. So you do have to be able to offer sort of a spectrum of solutions that really cater to different needs and different goals. And so there is a fine line to be drawn between obviously being true to label and being very clear and transparent about what a particular strategy or product might be trying to achieve, vis-a-vis kind of not wanting to be too prescriptive about shoehorning everything into a specific definition and like a finite set of buckets. So at BlackRock, we're a strong advocate for being very, very transparent, both in terms of what you're actually trying to achieve with a specific product or offering, and also the process that goes into that, but also equally being transparent about what that actually results in terms of the actual sort of metrics or performance on these types of questions as a result, if that makes sense.
Thank you. Well, actually, time is running out. And so I would like to close this session with a 1 minute comment from all the panelists. Actually, I received a question. And so I think I want all of you to answer this question in closing. So the question is, how do panelists evaluate their own progress towards medium-term portfolio targets, in particular with the most emissions-intensive sectors? And what systemic intervention will be needed to drive decarbonization at greater speed and scale, given the gap between targets and action? Well, that is a very tough question for 1 minute comment, but I believe everyone can do that. So first, Simon.
Thank you very much. So I don't think we're going fast enough. We're trying, and I think this session has demonstrated how complex this is, which I hope is helpful, because the lack of progress or the slower progress is not because we're not trying individually or collectively. It's because there are a great many challenges we have to solve to get there. And if there is one thing I think I would make an appeal for, it's, as shown by the launch of the Glasgow Financial Alliance for Net Zero, the finance sector is mobilizing at scale and wants to be a driver of change, but it cannot be the only one. And so I would just call for very careful policy making, balancing the transition between the enabling role of the financial sector, but the critical role that companies across all sectors of the economy need to play, and ensuring that those two levers are pulled at the same speed.
Thank you, Simon. So next, Keith, please.
Okay, well, thank you, Will. In a very quick 1 minute, I think, look, we have to admit we've got a very good framework now in the context of the GFAN's work, Action 100 Plus. This is much more now about implementation, right? And that means that we should be all putting pressure on companies, including those in the financial sector, to number one, disclose scope 1, scope 2, and scope 3. We know the difficulties in measuring scope 3, but it's got to just be worked out. But measuring and disclosing those 3 scopes. Secondly, all companies should be setting targets. And that's not just a net zero 2050 or thereabouts target, because there has to be some flexibility in terms of emerging markets versus developed markets. But also 2030 targets. This decade is the most critical. And thirdly, every company should have transition plans in place. All right. Now, every plan is going to be different, but we've got to get companies to think through. They've got to have a plan. They've got to have a strategy, and it's got to be consistent with a 1.5 degree world. Your question was about systemic intervention. It's a very good question. We can't slow down because we've got to get systems right, because that's a much bigger issue. But we've got to recognise there are 3 systemic challenges that we face. One is we do not have consistent, meaningful carbon pricing in the world. Secondly, we have enormous subsidies for the fossil fuel industry. still $400 billion out of direct subsidies. Both of those need to change. And thirdly, we also need to get to the root of measuring all externalities, positive and negative, for companies. So those three systemic issues we face, but we can't wait for them to change. They're going to take a while. We've got to get on with implementation, but also think about and start driving the system changes that we need. Thank you.
Thank you, Keith. So, Miyuki-san, please.
Okay. Yeah, it's very difficult. We see it, there is a big, huge gap. And also, as you know, the Dutch life is based in Japan. And thinking about the fiduciary duty, our customers is mainly in Japanese people living in Japan. So there's a lot of many companies which needs a huge transition. So we are in the same boat. So to shrink the gap, we have to make a coalition. We cannot do it by ourselves only. That's the reason why we joined the coalition. And we have to, our role is to how to accelerate the innovation and how to support as a financial institution as a main core Japanese asset owner. That's my role.
Thank you. So, Tomo-san.
Sure. So I think, as Mark kindly said in the beginning of this session, this GFANZ or Net Zero Banking Alliance, I thought the alliance itself is very important in the context of sending the signal or message to the real economy. So that's, I wouldn't say it's done, but given many banks have already set the target or in the process, I'm sure basically the real economy firms understand that the world is changing. Now it's we need to show the progress, and that's exactly, and Simon knows this, which is we can't just say here's a target, somebody will deliver for us. We actually have to go to our clients and convince, or at least explain, here's what we want to do and here's how we can help you. And that's exactly why I thought this transition finance guide will help, or basically allow us to have the conversation. And that's where I think engagement kicks in, and GFSA's guidance I thought was very helpful. So it's not just about the target setting; it's almost about engagement and using transition finance as a tool. And hopefully, transition finance will become mainstream product after we produce this guide. But of course, with the public sector intervention as well. Thank you.
Thank you. So, Emily-san, you are going to make a kind of finishing touch of this panel. So please go ahead.
Thank you. Well, I was actually going to finish on a statement that Ishikawa-san started with, which was not to let perfection be the enemy of good. So I'm glad we're on the same page there. Look, this is a really multifaceted question. And there's no one single magic bullet. But if I could pick one thing, I would say we're not going to succeed in the transition if we don't get this right in emerging markets. And I think we need to see greater public-private collaboration in order to get there. I think we need to be able to leverage more public finances from developed countries in order to incentivize investment into emerging markets and to decarbonize their economies. I don't think we're going to get there with the way that's working at the moment. So that would be my one recommendation.
Thank you. So that closes this panel. Thank you, all the audience, for joining this panel. And also, I would like to say a big thank you to all the panelists participating in this panel. Thank you.